ETFs are one of the easiest ways to build wealth in the stock market. But here's the problem. Most beginners invest in them blindly and end up losing money or missing out on massive return. In today's video, I'm breaking down the 10 biggest mistakes that could be costing you thousands in potential gains. Now, before we get started, this is not financial advice. I'm just sharing educational content about dividend investing. The content in this video is for informational purposes only and should not be considered as investment advice. If you're serious about making your money work for you, keep watching because by the end of this video, you'll know exactly what to avoid. So first off, what is an ETF? An ETF, or exchange traded fund, is an investment vehicle that holds multiple underlying assets in one convenient package. Instead of buying hundreds or thousands of different stocks individually, you get a slice of each company in one single product. ETFs trade on stock exchanges just like regular stocks, which means you can buy and sell them throughout the trading day. Now here's where it gets interesting. ETFs brought in $540 billion in new money during the first half of 2025 alone, which surpassed total inflows for the entire previous year. Everyone's rushing into ETFs because they offer diversification, low costs, and tax efficiency. But that convenience can also breed complacency. Many investors are making critical mistakes that threaten their financial goals. Let's dive into these mistakes so you can avoid them. Mistake 1. Chasing past performance. The first and probably most common mistake is chasing performance based on past returns. Just because an ETF made 50% last year doesn't mean it will do the same this year. According to certified financial planners, many investors rush into buzzworthy ETFs like Bitcoin ETFs, gold ETFs, or clean energy ETFs after seeing a massive rally. But here's the thing, these funds can fall just as quickly as they rose. Let me give you a real example. Remember when meme stocks were all the rage? The Roundhill meme stock ETF was launched, made some people money early on, then crashed. Former meme stock darlings like AMC and GameStop are now down more than 50% from their peaks. If you bought that ETF at the wrong time, you lost serious money. The lesson here is simple. Past performance is not a guarantee of future results. Don't invest based on what happened yesterday. Invest based on solid fundamentals and your long-term strategy. Mistake 2. Ignoring expense ratios and fees. The second mistake is not paying attention to fees. Small percentage differences in cost can have a massive impact on your returns over time. Let me show you what I mean with a real example. The SPDR S&P 500 ETF, ticker symbol SPY, has an expense ratio of 0.09%. The Vanguard S&P 500 ETF, ticker symbol VOO, tracks the exact same index but has an expense ratio of just 0.03%. That's 3 times cheaper. If you invest $10,000, but pays about cost you $9 per year, while VOO only $3. Over 20 or 30 years, that difference compounds into thousands of dollars. Now, some ETFs get even more expensive. For example, specialized ETFs like the Yield Max Bitcoin Option Income Strategy ETF have an expense ratio of 0.99%, which is hugely expensive for an ETF. Before buying any ETF, always check the total expense ratio. Make sure the costs are justified by what you're getting. Lower fees mean more of your money stays invested, and that's what builds wealth. Mistake 3. Assuming all ETFs are diversified. The third mistake is assuming that just because something is an ETF, it's automatically low risk and diversified. This is completely false. Not all ETFs are created equal. Take the Invesco QQQ Trust, ticker QQ, for example. This ETF tracks the Nasdaq 100 index. It's one of the most popular ETFs in the world. But here's what many people don't realize. QQ has roughly 60% of its assets in technology stocks, and about 50% of the portfolio is in just its top 10 holdings. That's extremely concentrated. If the tech sector crashes, QQ crashes with it. Compare that to something like the Vanguard S&P 500 ETF, ticker VOO. which is much more diversified across different sectors. VOO spreads your risk across 500 companies in multiple industries. Before buying any ETF, check its holdings. Don't assume it's diversified. Look under the hood and understand exactly what you're investing in. Mistake 4. Not understanding geographic exposure. The fourth mistake is not checking the geographical breakdown of your ETF. Did you know that many so-called global ETFs are actually US heavy? According to a recent report by Fidelity, the MSCI World Index has about 72% of its money invested in American stocks and only 28% allocated to the rest of the world. So when you buy a global ETF thinking you're getting worldwide diversification, you're really just getting a lot of US exposure. If the US market crashes, your global ETF crashes too. Before investing, always check where your money is actually going. If you want true geographic diversification, you need to specifically invest in ETFs that track Europe, Asia, and emerging markets separately. Mistake 5. Trading too frequently. The fifth mistake is treating ETFs like trading vehicles instead of long-term investments. One of the benefits of ETFs is that you can buy and sell them throughout the day just like stocks. But that doesn't mean you should. Over the past 10 years, investors who traded frequently underperformed those who held long-term. Every time you buy or sell, you pay trading commissions, spreads, and potentially capital gains taxes. These costs quietly erode your returns. The beauty of ETFs is their low cost and tax efficiency, but if you're constantly trading, you lose those advantages. Here's what you should do instead. Invest with a long-term mindset. Buy quality ETFs and hold them for years. Let compounding do its magic. Don't check your portfolio every day and don't panic sell during market downturns. Mistake #6. Ignoring liquidity. The sixth mistake is not analyzing the liquidity of the ETF. Liquidity refers to how easily you can buy or sell the ETF without significantly affecting its price. Low liquidity can lead to wider bid-ask spreads, which means you pay more when you buy and receive less when you sell. Here's the thing though, many investors screen out ETFs based on low trading volume thinking they're too risky, but that can actually be a mistake. The liquidity of an ETF ultimately depends on the liquidity of its underlying securities. An ETF that invests in blue-chip stocks can be liquid even if the ETF itself doesn't trade much volume. The key is to always use limit orders instead of market orders when trading, especially with smaller ETFs. A limit order lets you set the maximum price you're willing to pay, protecting you from getting a bad execution price. Mistake 7. Not matching ETFs to your goals and risk tolerance. The seventh and final mistake is not matching your ETF picks to your risk tolerance, goals, and timeline. Every investor is different. What works for a 25-year-old with decades until retirement is completely different from what works for a 60-year-old planning to retire in 5 years. According to experts, this is one of the most fundamental mistakes. You need to ask yourself, what am I investing for? Is it retirement in 30 years, buying a house in 5 years, or building an emergency fund? Your answer determines which ETFs are appropriate for you. Higher risk ETFs like QQQ might be fine for young investors with long time horizons. More conservative ETFs with bonds might be better for older investors or those saving for near-term goals. Now, how to access these ETFs? Now, you might be wondering, how do I actually invest in these ETFs? If you're in Nigeria, I highly recommend checking out the Bamboo app, which is available in the video description below. Bamboo allows you to invest in ETFs like VOO, VTI, QQQ, and many others directly from your phone with as little as $10. They offer fractional shares, which means you don't need thousands of dollars to get started. The platform is specifically designed for African investors and makes it easy to build a diversified portfolio of ETFs. All the links are in the description. Okay, if you want to learn more about ETF investing, connect with other investors, and get ongoing education without the hype, make sure you check the video description below. I've linked our free trading community, the #1 trading community on the internet. We discuss investment strategies, share portfolio reviews, and help each other make smarter decisions. It's completely free to join, and there's incredible value there. That's it for today's video. If you found this valuable, smash the like button and let me know in the comments which of these mistakes you've made before or which one surprised you the most. Remember, all investments carry risk and you should do your own research before investing. I'll see you in the next video.